There is a small group of people who meet 8 times a year in Washington, D.C. They sit around a table. They vote on a number. And when they announce that number, your mortgage payment changes. Your credit card interest rate changes. Your savings account changes. The stock market moves. Millions of jobs appear or disappear. Businesses borrow more or less. Entire economies speed up or slow down. You did not vote for these people. Most of them you cannot name. But every major financial decision of your life has been shaped by their votes. This is how interest rates work. And this video explains everything. What are interest rates? Let us start at the very beginning. An interest rate is the cost of borrowing money. When you borrow money, you pay back more than you borrowed. The extra amount is the interest. The interest rate is the percentage of what you borrowed that you pay in interest. If you borrow $100 at a 5% interest rate for 1 year, you pay back $105. The $5 is the cost of borrowing that money. Simple enough. But there are many interest rates. Not one. The interest rate on your mortgage. The interest rate on your credit card. The interest rate your savings account pays you. The interest rate between banks. The interest rate governments pay when they borrow. All of these rates are different. But they are all connected. They are all connected to one number. One base rate set by your central bank. In the United States, this is called the federal funds rate, set by the Federal Reserve. In the United Kingdom, the bank rate, set by the Bank of England. In Canada, the policy interest rate, set by the Bank of Canada. In Australia, the cash rate, set by the Reserve Bank of Australia. In the European Union, the main refinancing rate, set by the European Central Bank. All other interest rates in the economy flow from this one base rate. When it moves, everything else moves. Who controls interest rates and how? The Federal Reserve, commonly called the Fed, is the most powerful financial institution in the world. It was established in 1913. It is technically private, but functions as the central bank of the United States government. The Fed has 12 regional banks and a board of governors. The most important committee is the Federal Open Market Committee, the FOMC. It consists of 12 members. It meets 8 times per year. When the FOMC meets, it decides whether to raise interest rates, lower them, or keep them the same. Their stated goal is a dual mandate: maximum employment, stable prices, defined as approximately 2% inflation per year. When inflation is too high, the Fed raises rates to slow down the economy and reduce price pressure. When unemployment is too high, the Fed lowers rates to stimulate borrowing, spending, and job creation. This sounds straightforward. The reality is more complex. The Fed sets the rate at which banks borrow from each other overnight. This one rate then ripples through every other interest rate in the economy through a chain of financial connections. And because the US dollar is the world's reserve currency, the Fed's decisions affect interest rates not just in the United States, but in economies around the entire world. When the Fed raises rates, capital flows into US dollar assets. Other currencies weaken against the dollar. Developing nations with dollar-denominated debt face higher repayment costs. The entire world feels the Fed's decision. How interest rates affect your mortgage and housing. For most people in wealthy countries, their mortgage is the largest financial commitment of their lives. And interest rates are the single biggest factor determining what that mortgage costs. When interest rates are low, borrowing is cheap. More people can afford mortgages. More people buy homes. Demand for housing rises. House prices rise. This is exactly what happened between 2008 and 2022 in the United States, United Kingdom, Canada, and Australia. Interest rates were kept near zero. Mortgages were cheap. House prices surged. When interest rates rise, mortgages become expensive. In 2022, the Federal Reserve raised interest rates from near zero to over 5% in less than 18 months. The fastest rate rise cycle in modern American history. The monthly payment on a $400,000 mortgage at 3% interest, which was available in 2021, was approximately $1,686 per month. The monthly payment on the exact same $400,000 mortgage at 7% interest, available in 2023, was approximately $2,761 per month. Same house, same mortgage, same person. $975 more per month, every month. For 30 years. This is what rising interest rates did to the housing market, and why housing affordability collapsed so dramatically when rates rose. For existing homeowners with fixed-rate mortgages, the pain was deferred. For those coming off fixed-rate deals, and for anyone trying to buy, the pain was immediate and severe. In the United Kingdom, where shorter fixed-rate terms are more common, millions of homeowners faced shocking payment increases when their fixed deals expired in 2023 and 2024. How interest rates affect your debt. Every form of debt is affected by interest rates, but not equally, and not at the same speed. Fixed-rate debt is locked in at the rate when you borrowed. A fixed-rate mortgage stays at the rate you agreed when you signed. Variable-rate debt moves with the market. A variable-rate mortgage, a home equity line of credit, a credit card balance, these reprice when the benchmark rate changes. Credit card interest rates are the most immediately painful example. In the United States, the average credit card interest rate in 2020 was approximately 15%. By 2024, and it had risen to over 21%, matching the highest rate ever recorded. Every dollar you carry on a credit card balance is now costing you more in interest than at almost any point in recent history. Car loans, student loans with variable rates, business lines of credit, personal loans, the home equity lines, all of these repriced as the Fed raised rates. The total amount of consumer debt in the United States is approximately $18 trillion. The total amount of student loan debt alone is approximately $1.7 trillion. Every percentage point increase in the base rate adds tens of billions of dollars in annual interest costs across the consumer debt market. These are not abstract numbers. They are the extra money that flows out of ordinary people's bank accounts every single month and into the accounts of lenders. How interest rates affect your savings. Here is something that sounds counterintuitive. Rising interest rates are not only bad for individuals. When interest rates rise, savers benefit. The interest rate your savings account pays you is connected to the benchmark rate. When the Fed raises rates, banks pay more on deposits. When the Fed cuts, banks pay less. In 2020 and 2021, savings account rates in the United States were near zero, 0.01%, 0.05%. You were essentially earning nothing on your savings. By late 2023, high-yield savings accounts were offering 4.5 to 5.5% interest annually. If you had $50,000 in savings in 2020, you earned approximately $25 in interest for the entire year. The same $50,000 in savings in 2023, earning 5%, generated approximately $2,500 in interest. This is why many financial commentators describe the rate rise cycle as a gift to savers who had been penalized for a decade by near zero rates. But the benefit is not equal. The people who benefit most from higher savings rates are the people who have savings. People with significant cash savings, typically older, typically wealthier, benefit most from rate rises. People with high debt, typically younger, typically with lower incomes, are hurt most by rate rises. Rising rates transfer money from borrowers to savers, from younger to older, from less wealthy to more wealthy. This is not an accident. It is the predictable distributional effect of monetary policy, how interest rates affect stock markets and investments. Interest rates and stock markets have an inverse relationship. When interest rates rise, stock prices typically fall. When interest rates fall, the stock prices typically rise. Here is why. When interest rates are low, money in savings accounts or bonds earns very little. Investors search for better returns in the stock market. Demand for stocks rises. Prices rise. When interest rates are high, government bonds and savings accounts offer attractive guaranteed returns. Why take the risk of stocks when you can earn 5% risk-free? Money flows out of stocks and into bonds and savings. Stock prices fall. There is also a direct business effect. High interest rates increase the cost of borrowing for businesses. Companies that carry significant debt pay more in interest. Profits fall. Stock prices fall. High interest rates slow consumer spending. Less spending means less revenue for businesses. Less revenue means lower stock prices. The stock market crash of 2022, when the S&P 500 fell approximately 20%, was almost entirely driven by the Fed's rate rise cycle. Property values, bond prices, growth stock valuations, private equity, all major asset classes are significantly affected by where interest rates are. Your pension, your index fund, your investment account, all of them are directly affected by the rate decisions made 8 times a year by 12 people at the FOMC. How interest rates cause recessions and inflation. Interest rates are the primary tool governments and central banks use to control the economic cycle. They are used to fight inflation. And they are used to fight recession, fighting inflation with rate rises. The mechanism works like this. High inflation means prices are rising too fast. The central bank raises rates. Borrowing becomes expensive. Consumers borrow less and spend less. Businesses borrow less and invest less. Demand across the economy falls. With less demand, prices stop rising as fast. Inflation falls. This is the intended mechanism. It works, but it has side effects. Reduced borrowing and spending means reduced economic activity, which means lower business revenues, which means layoffs, which means higher unemployment. This is why the phrase used by central bankers, engineering a soft landing, matters so much. Can you reduce inflation without causing a recession? The historical record is mixed. The Fed raised rates in 2022 and 2023 to fight the highest inflation in 40 years. Inflation did fall significantly, but many economists believe the full recessionary impact of those rate rises has not yet been fully felt. Fighting recession with rate cuts. The mechanism works in reverse. Lower rates make borrowing cheap. Consumers borrow and spend. Businesses borrow and invest. Economic activity increases. Employment rises. The economy grows. This is why the Fed cut rates to near zero in 2008 and again in 2020 to stimulate economic activity during the financial crisis and the pandemic. The risk of rate cuts, and as we saw in 2020 to 2022, is that they can fuel inflation, asset price bubbles, and the very conditions that eventually require painful rate rises to correct. What should you do based on where rates are? Understanding where interest rates are and where they are likely to go is one of the most useful pieces of financial knowledge available to an ordinary person. When rates are high, as they were in 2023 and 2024, lock in high savings rates. High-yield savings accounts, certificates of deposit, government bonds. When rates are high, guaranteed returns on cash are genuinely attractive. Lock in for as long as practically possible. Pay down variable rate debt aggressively. When rates are high, variable debt is expensive. Credit card balances, home equity lines, variable mortgages, high interest makes these particularly damaging to your finances. Paying them down delivers a guaranteed return equal to the interest rate. Consider fixing your mortgage rate. When rates are at or near a peak, fixing locks in a known cost before rates potentially change. When rates are low, as they were in 2020 and 2021, refinance existing debt. Low rates are a window to lock in cheap long-term borrowing. Invest rather than save cash. Low savings rates mean cash loses purchasing power in real terms. Broad market index funds historically outperform over long periods when interest rates are low. Be cautious about locking in at low rates because low rates tend not to stay low forever. Understanding interest rates does not require an economics degree. It requires understanding one simple thing. The price of money changes over time. When money is cheap, borrowing is rewarded. When money is expensive, saving is rewarded. Aligning your financial decisions with where the price of money actually is, rather than where you wish it were, is the most practical application of this knowledge. Let us bring everything together. An interest rate is the cost of borrowing money. All interest rates in the economy connect to one base rate set by your central bank. In the United States, the Federal Reserve. In the United Kingdom, the Bank of England. In Canada, the Bank of Canada. In Australia, the Reserve Bank of Australia. These institutions raise rates to fight inflation and lower rates to fight recession. Rising rates make mortgages more expensive, debt more painful, and stock markets typically fall. Falling rates make mortgages cheaper, debt more manageable, savings accounts pay less, and stock markets typically rise. Rising rates benefit savers. Falling rates benefit borrowers. The distributional effects favor the older and wealthier when rates are high. When rates are high, lock in savings rates, pay down variable debt, and consider fixing mortgage rates. When rates are low, refinance debt, invest rather than hold cash, and be cautious about assuming low rates will last. Interest rates are not abstract policy decisions. They are the price of money. And the price of money shapes every major financial decision of your life. This is not financial advice. Please consult a qualified financial professional before making any investment decisions. Check out other Broke Monkey videos for more financial topics explained simply and clearly. If you want to support this channel so we can keep making these videos, check out the link below. Apes together strong.